Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Welcome to the Global View on this Wednesday. Let's check out what's going on at a macro level. Longer dated US Treasury yields fell ahead of the release of the consumer price index data for June. Markets are pricing in around 35 basis points of further rate hikes, yet Fed officials are flagging at least another 50 basis points of tightening. The yield on the 10-year note falling below 4%, while the 2-year was up close to 4.9%. Now, in more Fed speak, New York Fed President John Williams has said the central bank has more tightening to do, saying we are not getting the full effects of the restrictive policy that we've put in place yet. Those are still ahead of us, although we have gotten some of the effects already in certain interest rate sensitive sectors. Well, the US dollar index has fallen to a 2-month low on prospects that the Fed is near the end of its rate hike cycle, while falling to a 2.5-year low against the Swiss franc. And the Aussie dollar trading at 66.8 US cents. The British pound is close to a 15-month high after British wage growth hit a joint record high. Basic earnings surging 7.3% in the 3 months to May compared with the same period a year ago, putting more pressure on the Bank of England to tighten policy further. Meanwhile, German inflation rose 6.8% on the year in June, interrupting a steady decline since the beginning of the year. Well, the NASDAQ's performance in the States has been driven by AI and the Magnificent Seven, leading to an overconcentration in the indices. Well, Chad Padowitz is joining us now. He's the COO of Talaria Capital to discuss the market implications of that concentration we're seeing and perhaps a disconnect with the market. Chad, good to catch up with you.
Thank you.
I was just talking about this with our previous guest out of the States, in fact, on that concentration we're seeing of the Magnificent Seven, or Feynman, as some would like to call it, those 7 stocks that have been leading at the moment, with the NASDAQ looking to rebalance its 100 index due to that high concentration. Tell us more. What's your interpretation of what's going on?
Yeah, so obviously the exceptional performance of those shares over many years, actually, but more recently the recovery this year, which has been one of the strongest NASDAQ rallies we've actually ever had in a 6-month period, or 7 months actually, has led to, basically the top 5 companies in the NASDAQ being over 40% of the index, and as obviously the top 7 absolutely dominate, such that the NASDAQ itself has rules in place to avoid over concentration, because they do want the index to represent something more diversified. So they are making an adjustment where I think it brings those top 5 down from, as I said, in the mid-40s down to about 38%. So I don't think it's that material. There's not that many people that would potentially just index just to the NASDAQ, but it does show that there is concern that there's a substantial concentration happening. And they're all, while they're not completely identical companies, obviously, they are all IT companies. They are relatively correlated as well. So for investors that do have a passive strategy, any belief you may have that you have some diversified exposure to the economy or the market in general is very misplaced and actually puts you at disproportionately high risk, if the index, if some adverse events happen.
What is this disconnect that you talk about in particular in regards to what we're seeing here with falling composite leading economic indicators?
So look, interest rates obviously lead the economy, but by quite some time. That's why we have leading economic indicators that tell us where the economy is going. Usually the equity market follows it always ultimately follows the leading economic indicators, because obviously earnings are impacted by the economy. Now, occasionally there is a longer than usual lag, and there certainly was around the GFC period where the leading economic indicators came down, but it took some time for the equity market to drop. As you can see there, we're seeing that currently at the moment as well. We do think that nothing changes in terms of where you end up, as in higher interest rates with a lag of about 18 months impact the economy, and that impacts earnings and impacts share prices. We're at about the 18-month period right now. So it's not completely unprecedented, as I said, that the market is still quite strong, notwithstanding these higher interest rates and reduction in leading economic indicators. But we do think that it's absolutely now's the time where one should be particularly mindful of those risks.
Chad, you mentioned earnings. We're on the cusp now of earnings season, second quarter in the States, with the big banks leading off at the end of the week. What are you going to be watching out for?
Yeah, look, the actual earnings season, as in the 3 months past, we think, broadly speaking, certainly the companies we follow, we think they'll do just fine, and we're not seeing any obvious signs of adverse effects happening just yet, because unemployment's still pretty low, wage growth still high. Inflation has been drifting a bit down, which makes real wages reasonable. So because of that, I think the key thing to look for is the indications of where companies see things going. Do they change their forecast for later in the year? Are they seeing signs of these interest rates impacting their activities? So I think it's about what later on this year holds and next year holds, because that's where we're most concerned about where the economy and earnings are going, and we might get a greater glimpse into that with this earnings season.
Okay, Chad, let's then focus on some opportunities that you're seeing right now. I see that you're looking towards the UK with a multinational distribution and outsourcing company. Tell us more.
Yeah, well, we're a bottom-up investor, so we go where the value is. And one of the companies, as you mentioned, was a company called Bunzl. They are a global, they're based in the UK, but they're a global company. They do logistics and distribution of basically consumable items like fast food products and medical supplies and things like that. And they've been growing by incremental acquisition, for quite some time. So they supplement a sort of a low single-digit organic growth with a couple of 2 or 3% more from acquisitions, and they do that with the strong earnings power that they have and a strong balance sheet, which has never been stronger. So not only is their ability to keep doing that in the best state it's been, but their valuation is around 15, 16 times, which is around 20% lower than it's historically been, which is a function of equities outside of the US that are not part of this growth NASDAQ narrative have been somewhat left behind, and we see opportunities in companies like that.
Yeah, more broadly then, what are those opportunities, particularly, do you have a focus at the moment in the UK or perhaps, across the continent?
No, we don't. As I said, we're bottom up.
Yep.
We're not focusing on UK. We do have a relatively reasonable exposure across Europe, and that's one because we find the US market from a bottom up perspective to be unattractive. We're finding a lot more opportunities elsewhere. So as I mentioned, that UK name Bunzl, but also in Europe where we've got companies in the healthcare space, which we think do particularly well in this type of environment.
And which ones in particular are you looking at there?
So Swiss-based Novartis and Roche. We have Sanofi in France. We have Sodexo, which is a global catering company also based out of France. So that's just some ideas of where we're seeing other opportunities and also companies that are well placed for this environment of lower economic growth, higher interest rates, high inflation.
How are you looking at emerging markets at the moment?
Yeah, we do have some emerging market exposure, but one company I'll highlight is FEMSA, which is a Mexican conglomerate. Predominantly, they're a retail store operator for convenience stores, but they also own other assets. Emerging markets, some of the advantages they have is they have a lot lower consumer debt. So the global interest rate cycle is actually far less impacting on them. And many of them actually have far better sovereign balance sheets as well. Now, we're not investing in them for those reasons, but they do, they are generally, I think, a positive attribute in this environment as well.
Chad, always good to get your view there at Talaria. Thanks so much for joining us.
You're welcome. Thank you.
All right, that is the global view for this Wednesday. Just before we go, let's check where we're likely to get going, because you can see SPI futures up 0.5%. That was off the back of those very healthy gains we had yesterday, although bear in mind that was following 4 sessions of pain on the local index. And as I mentioned, some key points to watch out for today internationally, with the RBNZ handing down its latest interest rate decision. And then tonight, we get that key CPI data out of the States, which is going to be pivotal for markets. Stay with us. The Open is just around the corner.